I hope all of you are happy, healthy, and curious about this event. Before we begin, let's familiarize ourselves with what MMAC is. Now, all of you know the organization that is MMAC, but how about MMAC? Well, MMAC stands for Cumulative Aid for the Resident Elders, and it is a federal initiative funded by the Government of Canada to promote inclusiveness and support the senior members of our community. This initiative is responsible for the promotion of this seminar. Our guest speaker, Mr. Krishna Kumar Thottupurath, is here today to discuss everything we need to know about taxes. He's an accountant with over 20 years of finance, tax, and accounting experience, which means that he's an expert that will be able to offer assistance for tax and accounting related queries that you may have. Overall, this is the perfect opportunity to receive any answers to anything tax related that may be overwhelming us at this day and age. I would also like to give a warm welcome to our MC for this event, Mr. Adil Salman, who is the VP Administration for MMAC. Without further ado, I would like to invite Mr. Adil Salman to begin the session.
Thank you, Neha. A very good morning to everyone who have joined in today. And a very good morning to our to the person who is going to be explaining about the tax filing sessions today, Mr. Krishna Kumar. Thank you, Mr. Krishna, for joining us and taking the time to help us to have an understanding of what the tax filing system is here in Canada. How are you doing today, Krishna?
Hi, good morning, Neha, and good morning, Adil. Thanks for the wonderful introduction about me. I'm good, and it's
Excellent.
a beautiful Saturday.
Yes, it definitely is. It definitely is. Yeah. So before we start, with this session, Mr. Krishna, I just want to give a brief overview to our viewers. So we're going to be doing this in two sessions. The first session is going to be about tax information, and Mr. Krishna has a PowerPoint presentation, and he'll be going through that. The second part is going to be a small overview of the tax filing. And then we will have a Q&A. So our viewers, our community have sent us a couple of questions. So I will be going through that with Mr. Krishna. So without further ado, I'll be sharing the screen.
Yeah.
You can go ahead, Krishna.
Good morning, everyone. So first of all, I want to thank the organizers of MMAC for inviting me to this presentation today. And this is my second presentation with MAC. And I'm glad and thankful to the organizers. As Adil and Neha introduced me about my profile, I just want to a little bit add. So when I immigrated in 2007, I had made it my point to learn about the Canadian taxes. With that in mind, I joined an organization. Then they hired me for the tax season. While my performance was happy for them, they hired me continuously, and that relationship went ahead for nearly 5 years. So I had solid experience in tax system, and that is the experience I gained from there. I'm trying to share with you. I may not be able to share the complete one, but I'm trying to give you some horror stories as well as the fun stories. I will incorporate that in my session. Then before we proceed further, I want to give a disclaimer. The points that we are going to discuss today is only a general point and only for information purpose. And the people cannot take it as an advice for their situation. Every Canadian taxpayer is a unique situation, so they cannot generalize this information and take a conclusion. So for their unique situation, they have to go to a professional person and get to the case-to-case basis advice. And yeah, Adil, can we now proceed? So in the first session, I want to give an introduction about the Canadian tax system. So in Canada, the taxes was started in 1970. At that time, it was introduced as a source of finance to raise the First World War. Then it became part and parcel of the economy, and it is there since then with lots of amendments, and the present system and whatever it has reached to the present system where it is. So what is income tax? Income tax is the tax levied on the income of the people. So there are two types of taxes. One is income tax and one is sales tax, or what is called consumption tax. when you go to Walmart and buy certain items, you have to pay tax. That is called sales tax. So there are two levels of taxes here. One is called federal income tax. Second is called provincial income tax. And there is no gift tax or estate tax in Canada. Adil, you can go to the next slide. So in Canada, the tax system is very straightforward. It is called self-assessment system. Self-assessment means the taxpayer has the right and responsibility. I repeat, right and responsibility to file a tax return every year. And Canada Revenue Agency is the administrator of the for running the tax system and collect the taxes and pay to the government. So it is like federal and provincial government, they are helping. But most of the provinces, it is C.A.R.E. But in Quebec, it is called Revenue Quebec. There are three types of tax returns. Generally, the most popular and individual tax return is called T1 tax return. And the second one is for the corporation tax return. And the third is called trust return. So today our focus is to discuss about the personal tax return, which is T1 tax return. Then let us see what is the taxation year in Canada. So the taxation year in Canada is from January to December, which is called calendar year. So they have to give the income and their deductions. They have to show it for January to December period. Yeah. Let's see who has to file a tax return. Now, if you are coming from Middle East or India, most of the people don't file income tax returns there, right? So when a new person comes, they come to the reality of filing an income tax return because most of the people have to file a tax return here. When a newcomer comes to Canada, they have lots of myth they hear from their friends or families, but they may not have full idea about what they have to do on a basis to submit their tax return. So to summarize our requirement, it is for the newcomers, then who has got income and pay taxes, they have to file a tax return. If they believe that they have paid, over claim, they have paid more income tax and they want to claim a refund, they have to submit a tax return. If they have made any capital sales, then they have to pay capital gains on that. They have to file a tax return. Generally, people ask, what is the age for income tax filing? There is actually no age for income tax filing because if you have income, you have to submit a tax return. That is by default. So otherwise, it is from age 18 and above. Why it is age 18? Up to age 18, they get the child tax benefit. They are attached to the parents. But when they become adult, then they have to submit their tax return. If they have RRSP contribution, child care, tuition credit, and there are various other scenarios, in all those cases, they have to submit a tax return. Yeah, Adil, you can go next page. How is the tax return decided? So it is actually based on the residency status. So residency means it is the physical presence of the people. So it is generally calculated for 6 months, 183 days and above. If they are staying here, then you have to submit a tax return. So residency is also defined by their physical presence, not by citizenship. Then one more variation is that if you are a Canadian tax resident, then you have to submit worldwide income. What does that mean? Worldwide income means whatever income you get from other countries, that income also has to be reported here. But if you have paid income tax in the other country, then you can claim foreign tax credit for that. So you don't pay double taxation. Then if you are family, then husband and wife can file together. Then some of the credits can be transferred to the higher to the other person. Meaning, if the husband is making more money, then the wife's credit can be transferred to the husband. So that will help him to reduce the taxes. If you are claiming if you are submitting a non-refund tax, they are subject to only Canadian income. They don't have to submit a worldwide income tax return. So referential ties, how the referential ties are determined by C.A.R.E. So if the family is living here, immediate family, or you have a house, bank, car, or continuing state of relationship, then they will determine that you have a strong referential ties in Canada. Or if you have club membership, OHIP card, these are all the measures that C.A.R.E. determines to decide the referential ties. Then there are various types of income tax returns. Generally, for the people who are already in Canada, they submit a full year tax return. In that case, they submit the worldwide income. If they came during the year, if they are newcomers, then they submit a part year tax return. That means from the date of arrival to December 31st, they will submit a part year. Similarly, if they leave the country during the year, then they have to submit a tax return for the date of departure. Then if you are a part year, you submit your tax return for the part of the year you lived in Canada. That is for the people who arrived new or who is departing the country, emigrating clients. Then deemed non-resident is a person who is living outside, but the family is here. So because of that, he's got a strong referential ties. If he is submitting that, if there is an income from Canada, then there will be a withholding tax of 25%. If the person is working in some other countries, but they have referential ties, like this diplomatic persons, they are called deemed resident, and they also have to submit a full year tax return. Next one. Now, let's say when a new immigrant comes to Canada, they have to do a couple of things. They have to apply for SIN number. They have to apply for GST and child tax benefit. So these are the benefits are generally based on the income of the person. So you have to submit an application in the beginning. Then depending upon the income levels, they may get benefits, they may not get. When the income is high, the benefits will go down. When the income is low, benefits will start getting more. Then if they have properties back home, then they have to keep a fair value of assets. Then they can calculate the capital gains from the date of immigration. So that will help a lot of way for the people who have high net worth. Next one. If you are leaving the country, then you have to cancel the referential ties with Canada, like informing the bank, cancel your OHIP card. And if you have any property here, then you have to have the deemed disposition of property, settlement of home buyers plan. We will discuss about the home buyers plan later. We are coming up again. And tax filing for this one, there is no tax on principal residence sales. Then Canada is not the lowest tax country. US is having lower income, lower tax rate than Canada. But there are higher tax rate countries like Denmark, Sweden, Finland, Norway, etc. Now, how do you determine which province? If you have connection with another province, then December 31st is the determining factor. When wherever you are living on December 31st, that is the province you have to submit a tax return. If you have gone to Alberta on December 31st and you are coming back to Ontario on January 5th, it doesn't mean that you are an Alberta resident. You are still continue to be Ontario resident. In today's discussion, we are focusing mainly on Ontario because we are in Ontario. As I mentioned earlier, the tax returns are not generally, it is always from January to December. So after January to December, By February, we will be getting our T4s and all the slips from the government and the institutions like banks for your interest. All those slips will be getting. Then C.A.R.E will open the window for electronic filing by 3rd week of February. After that, we will start the tax filing season. April 30th is the deadline for a person to submit their tax return. If there is an extension up to June 15, if they are self-employed and they have to submit a self-employed tax return. So self-employed tax return is also the same like T1 general, what I mentioned before. Plus we will invoke some other schedules like T2125, where they will show their self-employment income and they can claim some expenses they can write off. But remember, if you have to pay income tax to the government, then you have to pay that by April 30th. Otherwise, there will be penalty and interest on the delayed payment of the taxes. Once you submit the tax return by April 30, then they will calculate the benefit like GST, child tax credit, etc. That is from July to next June. So they have the delta of 2 months, by which time they will calculate the benefits. If somebody died during the year, then there is a 6 months extension for filing their deceased tax return. It is generally April 30th of the following year or 6 months, whichever is earlier. There is one more requirement. If there is any high net worth individuals, they have properties outside of Canada over Canadian dollar 100,000, then they have to submit a form called 1135. So this is very expensive document, because if you don't submit this, you are liable to submit this document, and if you don't submit, then there is a penalty, huge penalty of $25 per day, subject to a maximum of $2,500. So you have to tell whether you are required to submit whether you have any foreign property or not. So when we do the income tax, there is a basic personal amount. This amount is changing always because this is based on certain statistical measures like consumer price index or living cost index. So right now for 2021, it is 13,808. And for 2022, it is 14,308. Every year, the amount will slightly change. So what does this mean? So basic personal amount, up to this amount, nobody will pay income tax. So if the employer has deducted income tax and your income falls below this amount, then you will get a refund. So I will come to that point separately in the further sessions. Now in Canada, there are 4 brackets of income. The first one is, Adil, can you show that brackets?
4 which brackets. File is it?
That is for the tax rates.
Tax
that Word
rates.
file. Yeah. Not this one. Yeah, the top one. So first bracket is from $0 to $49,000. There are two. I mentioned that there are 2 levels of income tax. One is federal income tax, and second is the provincial tax. So in Ontario, the federal tax is same for the entire country. Up to 49,000, we pay 15% federal tax. And can you please slow down, go down a little? Yeah. In Ontario, it is 5.05%. So when the tax return is submitted, they will calculate the person. They will combine this tax rate and they will calculate your tax liability. So first bracket is for up to 49,000. Second bracket is from 49,000 to 98,000. Then third bracket is from 98 to 150. Then 151,000 and above, the tax rates will be 29% plus 12% provincial. So around 41% tax, usually the people will be paying over $151,000 income bracket people. Yeah, you can go back to the PowerPoint. So that is what. Now, what are the methods of tax filing in Canada? So we can submit paper return. C.A.R.E will give you a booklet where you can fill up the information by hand and you can mail it to Sudbury. Sudbury is the tax center for people from Toronto. So you can mail it there. Or the easiest and most popular method is electronic filing. There are various softwares available. Some of the softwares are available on C.A.R.E website, which you can use. You can fill up your yourself and submit it electronically. If there is a refund, you can set up a direct deposit to your bank account. You have to submit your bank account details. So once it is electronically submitted, then it will take nearly 2 weeks for C.A.R.E to transfer your refund to your bank account. But if it is paper return, then it will take maybe 12 to 16 weeks of time. Yeah. Now, what you are achieving by submitting the income tax return. So you are declaring your income of yourself. That is what I mentioned by self-assessment system. So you declare your income, and there are various claims and tax credits that you can claim depending upon your situation. So you prepare calculate your income and deduct your deductions, then determine whether you have to get a refund or you have to pay balance. So government believes that you are an honest person and you will submit your tax return appropriately, and they believe you. So their job is they will verify the T4 slip or whatever slips you have. One copy will go to the C.A.R.E and they will match it with your return. So if it is matching absolutely as per their records, then they will approve it immediately. There are various refundable tax credits that you can claim depending upon your situation, like spousal credit. Who are married, they will have a spousal credit. So that means both of them will have the 13,000 or 14,000 limit. One person has got income and other person doesn't have any income. So when you are submitting the tax returns together, then the other person can credit, the higher income person can take the credit of lower income person. So that will help them to reduce their income tax payable, or they will get more refund. Then if they are a single person with child, then they can claim eligible dependent. So it is also like husband and wife. They can claim the credit for the other person. Then there are various other credits like caregiver, disability tax credit, interest paid on student loan, tuition fees, first time home buyers credit. All these are all non-refundable. These are called non-refundable tax credits, which is 15% of the amount. So let's say first time home buyers, when they buy a house, they just get a credit of $5,000. So they have to show that in their tax return. There are certain sessions where I can mention to you that later on. So $5,000 times 15%, that will give you a credit of $750. So that will be a wonderful thing. And you should know where to claim and how to claim this. So the persons, if they are doing independently by themselves, then if you are not aware about it, then you are just lost. C.A.R.E will not give you this credit. You have to claim in your return and C.A.R.E will approve it. So yeah. Now, if the student is coming here, then they have to have a tuition receipt. They have to report that tuition receipt in the same year. And if the parents are here, they can transfer the tuition transfer up to $5,000. So that will again 15% of 5,000. That will be around $750 benefit you have to get. Some students come to me, I don't care. I don't want to report my tuition credit. They will lose this credit then. So if they don't have income, the government will carry forward into the future years. And when the student completes his studies and become a full-time employee, this credit can be activated and they will get lots of refund. If it is, if the student is studying in foreign universities, then they should have a TL11A form. Then only they can claim the credit in their income tax return. If somebody is studying in flying school, they will get a tuition receipt of TL11B. One good news, lottery winnings are not taxable in Canada. So you don't have to report their 10 million income received from 649. But if the money is deposited in the bank, and when you get a interest, that interest is called second generation income, and you have to report that in your income tax. Tuition transfer, as I mentioned, that can be done only in the same year. So the student has to report his own tax return and report his tuition receipt. He can transfer up to $5,000. Then the father will get 15% tax credit. Then there is another non-refundable tax credit, which is medical expense. So when you have lots of medical expense, you can claim that. There is a 3% rule. What does that mean? Means 3% of your net income you have to absorb. The balance only can be claimed in your tax return as a medical expense. So that will reduce your income. So if this medical expense is claimed under the lower income person, if you are their husband and wife, then lower income person can report this, then you will get maximum benefit. For dependents, you can claim up to $10,000 in their in the tax return. Then usually it is for 52 weeks. But if the person died during the year, then you can claim for 24 months. 24 months, that is 2 years in the year of death. Then everybody know it is like a buzzword during the first quarter of the year, during the income tax time, that RRSP. RRSP is a tool to reduce your tax payable and saving for the future retirement. So what is RRSP stands for? RRSP is Registered Retirement Savings Plan. So the employer is registered with C.A.R.E. Then you can join you can contribute to the plan through your financial institutions. Then whatever amount you have contributed, that can be deducted from your income. So your taxable income will be reduced and you can pay tax for the balance amount. RRSP is highly monitored by C.A.R.E. So it is actually based on the earned income. Earned income means employment income or business income. Currently, it is 18% of the net income. Passive incomes like interest, dividend, capital gain are not considered for RRSP calculation. And one more thing, we have to remember that when the person comes for the first time, they do not have a RRSP limit. So they cannot contribute in the first year. Based on their first year income, C.A.R.E. will allocate a room, that is the 18% limitation rule. Then they can contribute as per that limit. Once you contribute for the RRSP in the bank, then the funds grow exponentially because the tax is not deducted. What mechanism this is having is, this is like a tax deferral system. It is not tax not paid, but when you withdraw from the program, at that time you pay tax. So the idea is that when you are working on your active working age, your income is high, you are saving for your future retirement, and when you retire at the age of 65 or later, then you can claim you can withdraw from the RRSP when your income levels are low. So that time you save a lot of income tax. That is the strategy of RRSP. Then people tell me that I have RESP, then TFSA. Those tools are not for tax purposes. They are all investments. RESP for educational investment for children. That is contributed from after the tax. So there is no tax deduction for that. TFSA is also tax deducted funds. So you can have TFSA in the bank, but it doesn't help you for your income tax. Then, as I mentioned, RRSP is highly monitored by C.A.R.E. if there is any excess contribution, then that will be the taxpayer will be penalized. Then you will have to pay, you will have to submit a tax return called T1 OVP. Then you have to submit a tax return, not a tax return, it's an application to C.A.R.E. called T3012A. Then there won't be withholding tax when you withdraw from the bank. If there is over contribution, then that should be within the limit, then you can deduct that in the following year. Then when you have RRSP, you can have home buyers plan. Means when you are buying the first principal residence in Canada, you can withdraw from the RRSP without any tax implication. Otherwise, when you withdraw, then there will be a withholding tax. Then there are some more non-refundable tax like childcare, moving expenses, support payments. All these are non-refundable tax credits where you can calculate 15% reduction. Carrying charges. Nowadays, a lot of discount brokers are there, like Wealthable. So people are tempted to do trading on shares in the stock market. So they will be paying a lot of commission, etc., that they can claim as a deduction in their tax return. They have to submit a Schedule 4 to claim this amount. Then we will be the people in Canada, when they are old age pension, they will be getting old age pension when they are 65. Then they can do pension splitting. Pension splitting is only for private pension. Like if you work for Bombardier, or then they have their own pension plan. So those type of pensions can be split between the other person. Other person means only for the husband and wife, not for other brothers, sisters, or etc. But the whosoever is claiming getting the pension, they also get a pension credit of $2,000. If you are getting Canada pension or old age pension, that cannot be split. Only the private pension can be split. That you have to note. Then when you have tax payable for previous 2 years consecutively, then C.A.R.E. will ask you to pay installment payments. So if you have received a letter from C.A.R.E., then you have to pay installment every quarter. If you don't pay that, then C.A.R.E. will charge you interest for non-payment. Then you'll have to pay that. Now you have submitted the tax return and you find that there are some corrections to be made. How do you do that? You can submit a T1 adjustment. You can do online, or you can, there is a document for that. You can mail it to Sudbury along with your supporting documents. So these are the information session. I hope most of you have benefited from this. If you have benefited, then I have accomplished my goal. So then we will proceed to the next session, which is called tax filing assistance.
Thank you, Mr. Krishna. There were some documents that you wanted to display
yes.
as well. Would you like me to go through that?
Yeah, let us bring up that T1 general copy.
Okay. So if you can just give me a second. Yeah.
Yeah. So I mentioned in my previous session that we are submitting a T1 general. So this is a copy of the T1 general. This is the finished product actually. So if you are doing electronic filing, for every input document, there is a page. You don't see that here, but when you input in that your T4 or tuition receipt or T4E for the employment insurance income, like that, for various slips you will be getting from C.A.R.E. When you input that in the appropriate page, you will see that in the output page here. So this return is like in the first session, you will show your identification, social insurance number, date of birth. Then you are, if you are married, then you have to, your marital status is shown here. Which province you are submitting your tax return. Here, this is Ontario return. Then in the husband's page, you will also see the wife's social insurance number and her income. Then you also have to mention whether you are a citizen or permanent or not. Then they will share that information with Elections Canada. Based on that, they will send your information about your, they will share the information with Elections Canada for voting. Then there is another section where foreign property. See right here, there is a foreign property question. It is asking whether you have properties abroad for more than $100,000. If you say yes, then you have to show that 1135, which I mentioned earlier, that form. If you don't have, then you can say just no. Check mark that box. Yeah,
I can continue with
this one.
Yes.
This one is better, Adil.
Yes.
So now let us see. So let's see. This is the income worksheet actually. So now you see on the right 10, 100. This is the income pages. So this describes 101 is, you can see on the left side, it is employment income. So this column is receiving from the T4. So whatever income you received, that will be mentioned on that line. Now following lines are all income lines like commission, tax exempt income. Then if you have foreign income, that will go on 10,400, old age pension, CPP pension, disability benefit. These are all various income from 101, 10,100 to till the bottom of that page. These are all income line, various income line. So depending upon your situation, these columns will be filled up once you do your tax return. Then it will go to the next section. Yeah, this is line 150. This is your total income. Then you go to the next section where they will calculate the deductions. So the first one is 208, the RRSP deduction. If you have contributed during the season, then it will come on that line. That will reduce your income. Then there are various deductions: childcare expenses, disability, moving expense, all those things you deduct, and you go to the next section. So this is called line 236, which is the total net income. And below that, there are some more deductions. Go down, and line 260.00 is the taxable income. So your tax will be calculated based on this income. Once you input all this information, the system will automatically calculate your income, and you will see below that the tax brackets. So whatever tax rate is there, based on that, the system will automatically calculate your tax payable. And federal non-refundable tax credits will be calculated there, and it will go down. Yeah, keep going. These are all the deductions: federal non-refundable tax credits, home buyers amount, home accessibility. There are various credits that you should be knowing about your background. Then keep going down. Then federal tax payable, and the system will finally decide whether you have to pay tax or you will get a refund. So this is what it is: refund or balance owing. If you have a refund, C.A.R.E will pay you the refund in 2 weeks' time. If you have balance owing, then you have to pay that amount before April 30th. So this is the tax return that everybody is submitting. This is the finished product. Then there are other various input documents on the others in the software itself, if you are using a software. If you are not using the software, if you are doing a paper return, then you can straight away fill up these columns. Then you can mail it to C.A.R.E. And the taxpayer has to sign and the following lines. Can you go down? Yeah. So this is the place where you have to sign. If the electronic filing, then there is another document called T183 where you will sign. There's only one page. Then the tax accountant will take that from you and he will electronically file it in his system. So electronic file, he should be an electronic filer. There is a license from C.A.R.E. Then he will file electronically on behalf of you. Yeah. Now can we go back to the PowerPoint?
What are some of the softwares that is usually used?
There are various softwares available on C.A.R.E. website, like TurboTax, that is by Intuit, then TaxTron. There are various H&R Block tax software is there. Then there are so many other softwares are there on C.A.R.E website where you can use it. But the key thing is you should know how to use it. If you don't check mark in some boxes, then you may not get some of the refunds.
Right.
So some people want to avoid going to their tax accountant, then they do their own taxes, then they might end up in, losing lots of credits. So they have to take care of that.
Right.
Yeah. Now can we go to the next?
Yeah, so I guess that was the 2 sessions. So we can jump straight into questions. So let me see. Go into gallery view. So I have a couple of questions that that was provided by our community. So I'm going to go through them one by one.
Yeah.
So let's see. The first one is for incorporated. I have seen many take dividends rather than salary out of the company account. Which one is beneficial in terms of saving tax? And is there a balance between those we should do that helps us to pay less tax?
Yeah, this is a general question I face every day during the tax season. So when you have a corporation, what C.A.R.E wants is that you have to set up a payroll account and pay your taxes. You have to deduct income tax and CPP, then pay to the government upfront. Most of the people don't do it. What they do is they do it in a simpler method. What they withdraw the money as per whenever they want, and they convert that into dividend at the end of the year.
Right.
C.A.R.E may approve it for few years, but ultimately one day they will come back to you and they will ask you to pay payroll tax. So they will ask you to open your payroll account. But there is no difference between, because the income tax doesn't have one method is beneficial compared to the other one. There is no system like that. It's all worked out in such a way that they don't lose the taxes. So whether you have a payroll account or dividend method, you will not save anything. But what the difference is, if you pay income tax, then you will have less money in your pocket. But if you don't pay, you don't have a payroll account and you pay based on the dividend. So what happens is you pay income tax based on the net income. So you pay less tax after the expenses. So you will have more money in your pocket. So some people take the payroll, then they get less money, so they don't have any tension. But the other people pay less money, they have all the money in their pocket. So that is the difference. So depending upon your appetite, you have to decide which category you are into, and depending upon your mindset, you can decide.
Yeah, thanks for that.
I hope that helps him.
Yeah. Okay. So we'll go to the question number 2. Are there any new tax refunds we can claim for last year because of COVID?
For COVID, in 2020, when the COVID started, they had a home office deduction of $2 per day. So in 2020, they started from March 15th, I believe. So 200 days they can deduct, and in 2021 it is 250 days. So $2 per day means $500 that they can deduct as an home office expense for sitting from their home and using their facilities. But this is not a $500 refund to you. $500 will be added to your income, and they will calculate the income tax at your tax rate, and they will pay you the difference. So you may get a slightly higher refund. So that is the only thing I can think about COVID benefit. But there is one more variation, that when the COVID started, they stopped charging interest on the tax payable. So people have to remember that benefit is going to expire on April 30th of this year. And if you have to pay pay the balance, then you have to pay that before April 30th. Otherwise, there will be interest on that amount.
The payable that you meant is the tax that is owing to C.A.R.E?
Some people have got more money which they are not eligible for. So such people, they have got letter from C.A.R.E and they have to pay back. So those payments are due for payment on April 30th, 2022.
Okay. Yeah, I think that is a very critical information that we have
because
to
it is
keep
it's
note
very
of.
critical. Otherwise, there will be heavy interest. The interest, I can also give you a heads up about the interest. So the interest is actually 1% of the balance payable. But if there is any penalty for not filing the tax return on time, then that is a 5% penalty on the balance owing amount plus 1% interest. So it will be like 6% per month. So the taxpayer has to take care of that.
I see. Almost 6% per month. That's a lot of money. So yeah, we will have to keep note of that. Thank you, Mr. Krishna. I'm going to question number
day-to-day basis. So, but they calculate like that.
Yeah. Okay. I go to question number 3. How to save tax other than RRSP, RESP, TFSA? You mentioned that RESP and TFSA isn't tax saving.
It is not a tax saving tool. But RRSP is the tax saving tool which is very popular in Canada. So that is again highly monitored.
Is there anything else that other than those?
To my knowledge, I don't find anything else where you can save tax. RRSP is the best tool for that.
I see.
It is also a future savings for the retirement.
Excellent. Okay. Question number 4 that I have. How the tax calculation happens for assignment sale and sale of investment property?
Okay, that's a good question. People go for buying real estate properties.
Yes.
Real estate property is very hot in the hot market now.
Yes.
So whether it is assignment sale or usual sale of the investment property, whatever profit you make on that, 50% is taxable capital gain. Meaning that amount will be added to your income, and based on your tax rate, you will pay tax. So assignment sale is just before the closing. I think it is 2 months before the closing. So the rules are same for the capital gain, whether you buy real estate property or stocks, shares, any other assets. Then the rule is same: 50% of the taxable income, 50% of the profit is taxable income. That gets added to your income amount, and you pay tax.
So, for example, if there is a profit of 100K from a sale, then 50,000 will go to our taxable income.
Yeah, so 50,000 is taxable income.
I see.
For that, let's say 10,000 is your tax. So you got 100,000, 10,000 you are paying, so 90,000 goes to your pocket. That is the way it is calculated.
I see. So it's the same for assignment sale and sale of investment property.
Assignment sale and normal investment property sale, it's all same.
Okay.
And if you are selling a principal residence, then there is no tax. But for the last 3 years, C.A.R.E has made it a rule that you have to report your principal residence sale. So there is another form that you have to invoke in your tax return.
Okay. So in short, principal residence, no tax, but if you have other investments, you have 50% of it is taxable income. The profit is taxable income. Okay. Good to know. Thank you. So question number 5, filing taxes for sole proprietorship, and when do we have to register as an LLC? And what taxes will I be looking at both these stages? So proprietorship and LLC, I think that's the limited company.
LLC is limited liability company. So it is like a corporation.
Right.
It's different name, but the structure is like a corporation. So when you incorporate, it is like having a child. Once you have the incorporation, then you have to, when you have the child, you have to feed the child, irrespective whether you are working or not. The corporation is also like that. You have some reporting requirements. You have to submit your tax returns every year, irrespective of their activities. If there is no activity, no income, but still you have to submit a nil return. And if you have a HST registration, then you have to file a HST return. But at the same time, if you are having a proprietorship business, then you submit your personal income tax. It goes along with the personal. There is another schedule called T2125, where you describe about your business activities, the income, expenses, etc., and show the net income from the business, and you pay tax. So this is the difference between sole proprietorship and incorporation.
Okay.
Then incorporation, the tax rates are different. So in Ontario, you might be looking at around 15 to 18% tax. 50 to 80% tax, and that is it will be two level actually. One in the corporation level, and you have to report that dividend whatever you have taken, that you have to report in your personal tax. So two levels of income tax you have to handle with. Yeah.
Okay. Question number 6. This person, thank you for this session and looking forward to this. I am a Canadian citizen working in the US. My family is in Canada, but I spent majority of the time in the US. So first part of question is, should I be filing a non-resident in Canada and my family as a resident of Canada? Can we still file jointly? And question number 2 is, how do I claim dependence exemption? Should this be in Canada or the US?
So first part, according to me, this person is living Canada, his family is living in Canada,
yes.
And he is working in US.
Yes.
So that means I mentioned that it is going by referential ties. So the families here means his strong ties are there with Canada, even though physically he is working in US. So he has to submit a Canadian tax, like a Canadian resident. Then for the US income, he has to submit a tax return in US. Like he will be like a foreign alien return, I believe. I'm not a US tax expert, so US return. Then whatever tax he has paid in US, that can be claimed as a deduction here, foreign tax credit. Yeah, so he has to do like that.
I see.
Then what is the second part of the question?
Second part is, how do I claim dependence exemption? Should this be in Canada or the US?
Yeah, the US part I may not be able to explain properly, but for Canada, you have to claim as a family tax return, like what we mentioned in the other session. So if the spouse is not making much money, then you can claim the spousal credit. So it should be a Canadian tax return like a resident.
Right.
Yeah. The same way, like people living in Niagara, Ontario, and working in Buffalo, so they'll be submitting the same type of return. Their families are here, so they come back every day. They cross the bridge and work in Buffalo.
Yeah.
The same situation.
Okay. Good to know, actually. There's a lot of like tech people who would try to find a job in the US while staying in Canada,
yeah, they
or
live
travel
here.
between to
yeah,
and fro.
Yeah, so it will be the same. So if they have two incomes, then Canada like worldwide income. So they have to report that, and whatever tax they have paid there in the other country can be claimed as a foreign tax credit. So you don't pay double tax.
Right. Okay. Question number 7 that I have. If I'm earning 70K and I have medical expenses around 18K, will I get a significant refund by including these medical expenses? There is a second part. I've heard I can get audited since it's a huge amount, but does being audited once put me at a higher risk of being audited again in the future?
Yeah. So when he has got 70,000 income and 18,000 medical expenses, so I'm assuming that he is a single person. So 18,000 medical expenses, 3% rule I mentioned earlier. So 3% of 70, $2,100 has to be deducted from that 18,000, and he can claim the balance as the non-refundable tax credit. So he will get benefited. He will get a lot of benefit. As long as you have all the receipts and your claim is very genuine, you don't have to worry about C.A.R.E coming back to you. You should be able to produce the receipts. Then there is nothing. Just because you claimed this, and in the subsequent years, they are not going to flag you for subsequent audit. So if the claim is genuine, then you don't have to worry about.
Right. Yeah. Okay, good to know.
Yeah, that helps a long way to save a lot of taxes.
Yeah.
If he is a family person, then the lower income person can claim the medical expenses. Then the refund will be more.
I see.
Yeah, so that mechanism you have to work out.
I see. Yeah. Okay, that is good to know. Thank you, Mr. Krishna. I have a couple more questions. I had got like one late question. So what I understood is that to gain GSTHST and welcome package, we have to let C.A.R.E know we have zero foreign income in the past years. If we are doing that way, then will it affect if we mentioned foreign work experience while applying for PR? I mean,
Yeah.
would C.A.R.E. and Immigration Department share data between each other?
Yes, absolutely. So when the newcomer comes, they have to submit a GST application form that might ask you your previous income before coming to Canada. So based on that, they may get some benefit from the government. It is called a GST credit and a trillion benefit if they have paid rent during the first year. So this is the benefit they are getting, but people say here, welcome Canada bonus and all those things. There is nothing like the tax code, welcome Canada. So this is what it is. But you have to be careful. Immigration Service Canada, Canada Revenue Agency, all they share the files. So if you have reported for your immigration purposes some income back home, then it is better to stay with that. Just for getting some small gain, small benefit, if you change your information, then that might bounce back later on. So be careful.
So my understanding is that as soon as you land in Canada, you have to make sure all your files and what you are reporting is in order. So that when you apply for PR,
yes, it will. It will. Be careful about that. So just for a small gain, you should not be making mistakes.
Right.
Yeah. So they will share the files. Absolutely.
Right. I think I had one more question on YouTube, but it has been retracted. I don't see any more questions, any more live questions. And we are well within our 1 hour time limit.
Yeah, it is.
Yeah, excellent.
So anyway, it was a wonderful session. And I want to thank all the organizers of MMAC for inviting me to this platform on a wonderful day and present the information about Canadian tax system. Of course, I was not able to give a complete overview of the Canadian tax system in 40 minutes, but I try to make a connection between the taxpayer and Canadian tax system. And I hope I have been truthful to that. Then I know that MMAC is doing a lot of charities for the community, and I'm glad that I've been part of that this one. And I was also invited last year, so I am thankful to the organizers of the this episode incident and the organizers of MMAC.
Absolutely,
Thank
Mr.
you.
Krishna. And we really appreciate you taking the time also to explain about the tax filing system. For me, every year, this is it's a big hurdle that we have to go through. And every year we have to relearn.
It is my pleasure to give a demo of my understanding and my capabilities at this platform. If, as I said, if some of them have enlightened because of this session, then I am happy and I'm accomplished.
Excellent. We appreciate that. Thank you so much, Mr. Krishna Kumar.
Thank you. Thanks, Adil. Thanks, Neha.
And so I guess I don't have anything else. So over to you, Neha. You can wind this up. Thank you very much.
Thank you.
Thank you, Adil, and thank you, Mr. Krishna Kumar. Since we've approached the end of the MMAC C.A.R.E. tax filing info session, I would first like to thank Mr. Krishna Kumar Thottupurath for educating and providing us guidance on this significant topic. We are also extremely grateful to the Government of Canada for their sponsorship in this event. And I would like to bestow a huge thanks to all of the organizers and our MC, Mr. Adil Salman, for their time and effort in preparing this session for all of us. Lastly, thank you to our audience for your attention and participation in our tax filing event. It is pretty evident that a lot of information was shared, and I definitely feel like I've learned a lot, and I hope you guys feel the same. It's been a pleasure to be with you all. Thank you, and have a great afternoon.
Thank you. Thanks, all of you.